Prepare for the S&P to drop by 23% into next year. Oh my goodness, that sounds pretty scary. What we're going to talk about today is the fact that the S&P has gone up, it's going sideways, and now the risk is that we could either be going for a move lower, or we could already have that move underway where now we start to flatten out and really start to go sideways. That's really what I want to talk about today. We're going to go back to this article published today by JP Morgan telling us that prepare for the S&P 500 to plunge by 23% by mid-2024 and the U.S. economy to sink into recession, JP Morgan's top chart guru says. So we're going to come back and look at the guru in a moment, but what I want to focus on is the fact that the S&P could not be going lower from here. It could actually still be going higher, but what we're not sure about is whether we're actually going to hold the low here. We went through this extensively on the pre-market stream. Hopefully you had a chance to watch that, but let's make it really simple. Because if we flip here to a line chart, there's two things I want you to pay attention to. The first thing is just that we've been going flat like a pancake for a while. We finally got a tick up, and then we tick down, but it's actually above the previous levels here. And all we're looking at for a line chart is the closing price. So by purely looking at a closing price, we note that we go up, we get a little bit of a move lower. So if we start to go back up tomorrow and we get above 460, again, a lot of if and when. Yes, I understand that. There's a lot of potential here. But if we get above 460, we could have negated the need for us to actually dip into late November, and we could actually be right here where we start to just go sideways. If we don't break that high, it means that we're likely somewhere in this period, and all it's going to take for us to confirm that would just be for us to print a weekly lower low, which just means us getting below 453.34. We're not really asking the chart for all that much, and it would be about a $1 lower move than the low we have so far this week. The low was exactly $1 off last week. We're also awfully close to the high here on the week, which means just on Monday in one single day, we got almost a full inside bar. Almost all of last week's trading range was tested on Monday. That's like pretty important. And if we move forward here to the NASDAQ, what do we note? Well, it's looking a little bit like we're getting a topping pattern here, right? A little bit of a shoulder, a little bit of a head, a little bit of a shoulder. Well, if we know that chips lead tech and tech lead SPY, S&P looks strong. But as we go down, this is starting to look a little bit weak. We've actually even filled the gap going back to November 10th. And this is definitely starting to hook. We got a dead cat bounce and an inside bar. If this inside bar breaks bear, well, that's probably resistance. If that inside bar breaks bull, well, I'll be looking for a retest up here to about 160 or back up here to our relative highs at about 161. That's pretty much it. But it's pretty obvious. So like if we just go to a line chart, again, the humble line chart, it looks like it's pointing down. Doesn't mean we have to go lower. It just means that momentum is starting to wane. So if we look at the fear and greed, is fear and greed starting to wane? Well, not in the first part of distribution. People are greedy. They're excited. They want to buy. And sellers are happy to sell to them. So let's be very mindful of that. All right, so now that we got the stuff out of the way, if we go bottom up, we're going to go chips lead tech, tech lead SPY. Let's look here to the heat map and see if there's anything notable for today. If you look back to the 1 week, what do we note? Oh, okay, we got some red blocks. Let's see if we can actually organize these. There we go. We put the largest blocks or no group. What do we note? Other than Amazon and Apple, the A team, everything's red. Google, Microsoft, NVIDIA, Meta, right? It's looking a little bit more red. Zoom out once more. There's our good old friend, Mr. Green. Yes, that's right. So in the short term, it just looks like everything else is picking up for the sell-off from yesterday, rotation back to tech. But in the last 1 week, there's some notable red blocks here. And we've been talking about that in terms of the weekly charts for Apple, right? We got that pattern. Apple actually now was a bullish engulfing weekly. Yes, flex it, Apple, biggest stock in the world. Let's go. Looking here at Microsoft, bouncing off its previous top, failed breakdown, has to keep advancing from here. But we do see those lower highs and lower lows, lower highs, lower lows. I'm not going to bore you with that because we've already talked about it extensively, but I'm going to ask you for a huge favor. Could you please consider smashing that thumbs up and subscribing to the channel? Whoops, there's a big one. Sorry about that. I meant to do the small one. There we go. Smash a thumbs up or subscribe to the channel. Thank you so much ahead of time. I appreciate your guys' support, and I'm grateful you guys choose to support me and watch these videos every day. All right, so let's go back to that big, bad, scary article from the chart guru at JP Morgan. Let's see what this guy has to say, because as much as if you're on Team Bear, if you can understand what he's explaining in here, it means you understand what a guru, what his perspective is. And then if you start to see evidence that he's wrong, it means you're wrong. If you're bullish, It's not that we need to agree with everything they say in this article. It just means that we want to be receptive to why people on the other side of the tape are bearish. And I'll backdrop this by talking about here. And we talked about the seasonality chart. And then there's one more thing we're going to talk about after we get through this article. So the highlighted bullet points here give us some high-level overviews, and they tell us that the S&P is likely to tumble 23% to 3,500 points by mid-2024. Oh, that's something to look forward to. Jason Hunter, the bank's head of technical strategy, let's make it a little bit bigger, views a U.S. recession as very likely. And he's what? He's a guru. He's a chart guru. What's missing in the article? A chart. Right? So ironic. But anyways, let's keep going. Jason Hunter, blah, blah, blah. Hunter sees cash and treasury bonds as safer bets than stocks today. Okay. What are his points? Stock market is mistakenly pricing in a soft landing for the U.S. economy, where the Federal Reserve succeeds in crushing inflation without causing a recession. Blah, 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 blah. Some will soon realize the outlook is darker than they thought, right? Those dark storm clouds are coming, is what he's saying. You tend to find your way into a bear market that's eventually associated with a recession way more often than not. The odds are stacked in favor of a hard landing, actually. Blah, 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 blah. We're going to have a lot to stall. We're going to have to go back down to stall speed. What does that mean? The charts are going to have to cool off. They're going to have to go sideways. Well, we know we go down, we go flat, we go up, we go flat, we go down. That's exactly what he's telling us here. The charts have to cool off. What does that mean? They have to go sideways. And it also means that GDP needs to come down dramatically. Let me show you that number here, because France is now starting a recession, Canada starting a recession, Japan starting a recession. The US is the best game in town, but we need to get down closer to zero, which means stalling out, where we get almost no growth, and then you'll understand the reason why. We're going to have to go to stall speed, which basically means zero. That's what enables the Fed to start easing in the second half of the year. The market's going to have a significant gut check on whether inertia is going to carry a recession or not. Stocks should pull back. Okay, so he's telling you the reasons why, and he's saying that we should retest the lows. Oh, God, that's the October low at roughly 3,500. More positively, Hunter suggests that stocks buoyed by lower interest rates could register fresh highs in 2025. And just to give you the other side of the coin, Wall Street strategists are divided on where the market is headed from here. For example, RBC's head of U.S. equities, Lori Calvasina, told Yahoo Finance on Monday that the S&P could climb to 5,300 next year. Whoa, that's an 800-point difference. And what he's talking about is that the market's going to have to get a gut check or to reprice. What do we read here? Market seems too optimistic on Fed cuts. Market too optimistic on Fed cuts. Stock market appears too optimistic by pricing in Fed cuts. Stock market appears too optimistic. Goldman favors options to counter excessive rate cuts. Fed Powell calls talks on cutting rates premature. Markets see spring rate cuts. The Fed isn't there. So the market's like playing chicken with Jerome, and Jerome's probably going to win. Why? He's the one to control the money printer. And let me pull up this one more article here, because this is really the one that I think is going to be... I can't actually... let me see if I can find it here. This is not the one I was looking for, but this one's pretty funny. Everything rally brings out the mealy mouth in Powell. Look at that little pout, right? He's like, man, I wanted stocks down. I wanted to be the Grinch. Mission not accomplished. Well, that's pretty much it. Don't have a very much more for us to go through, but you can watch the weekend review, which I now have queued up here on the left-hand side, or you can subscribe to the channel. I will be live at 9:15 Eastern tomorrow. Otherwise, thank you so much for tuning in. I look forward to seeing you tomorrow.